Recording in progress.
Hello, welcome to Couples Create Cash Flow. My name is Jordan Johnson. I'm a certified financial coach. Today, I'm bringing you a topic, why I stopped velocity banking. So, I want to just let you know why I haven't gone back to velocity banking for my personal finances. I usually talk about how great velocity banking is. Well, this is going to talk to you a little bit about the other side of it. Um, to get started, I want to tell you what my journeys looked like with this. In 2017, I bought a house. In 2018, I needed to repair a barn that was on my property. So I looked into HELOCs and discovered velocity banking, did a lot of research. Wasn't quite ready to jump into the debt payoff thing, but I was able to get the HELOC, $35,000 worth of equity, I believe, and use that to pay for the barn repair. Fast forward a little while, making payments on that, getting that paid down. 2019, I decided to get into the rental real estate space. We found a home that was distressed in our neighborhood, and we were able to buy it for a cheap price, fix it up, and put it on the market as a rental. Got a renter in there right away and became cash flowing house right away. It's pretty cool. So in order to do that, we had to increase the credit line of our primary property. That was our second HELOC. And we did that because the auction required a cash purchase for that rental property to be purchased. So we had to come up with a way to purchase it without a loan that was attached to the rental property. Our third HELOC was actually a HELOC on the rental property. So I talked with my lender, had a good relationship with my lender, said, hey, I'm kind of running into an issue where I need some cash flow or not cash flow, some money, because I was trying to repair it to get a renter in there, and there wasn't cash flow coming in from that home yet. So I needed some extra funds. And because we'd bought the property free and clear, we ended up being able to put a HELOC on that. So yes, you can put a HELOC on a rental property. Depends on what state you're in, but in this case, they allowed us to put a $75,000 HELOC on that because we had no previous mortgage. Later on, what we did was we converted that to a 30-year mortgage, um, basically so that the monthly payment stayed the same, very predictable, but always match up with the income that we got from the renter. And it also allowed us to actually do a cash out refinance that paid back down our primary home's HELOC. So it kind of was moving debt around, but what it ended up doing was assigning the debt that was responsible to the rental house back in the rental house's name, for lack of a better term. So that way, when we were paying down the rental property's debt, it actually matched up well with that. So um, our fourth HELOC in 2022, between 2019 and 2022, I bought a practice. I'm a practicing licensed not psychologist, counselor. I do therapy work with adults, and I bought a private practice. So put some money towards that purchase, and was able to get started as a business owner. So at that point, I had a business, a rental property, primary home, and the HELOC was kind of the main engine I was using for that. My wife and I were also both working full-time jobs, so we had two incomes. Family was getting bigger, and things were starting to shift. So what changed? Well, in 2023, my family and I relocated from Wisconsin to Virginia. We wanted to get to some warmer weather, and that what that meant was we had to sell everything. So we sold our rental property, my therapy practice, we sold our primary home, which then closed out our HELOC. Now, this is something that a lot of people don't talk about, but it makes sense. When you pay off your house, you actually pay off the mortgage, you pay off the HELOC. So whatever balance is on the HELOC and the mortgage put together, that gets taken out when they factor in how much money you make from the sale of your house. So you don't bring your HELOC with you after you sell the house. Good thing to remember. So then on the flip side, I had to purchase the new home that we were purchasing, sight unseen, by the way. We did a video tour and didn't actually walk the house, which was, problematic in some ways. Um, we purchased that on a 30-year loan and it needed some work. So we had some extra funds that we were able to spend on fixing up the property. And we had some extra funds in the sale of our home, but we didn't have a ton. And so there wasn't a ton of equity in the new home to tap into for a HELOC, but we had the cash. All right. Well, while we're fixing that home up, we decided that it was just not going to work for us to live there. What we didn't know, what was not visible on the listing, was that this home was right next to a major highway, and we had kids. Didn't want the kids, too close to the traffic that was whizzing by all the time. It was not exactly what we were hoping for with settling down, and we didn't know the area at all. So for us, it was just kind of a, leap of faith to move in the first place. Once we got to our first house in Virginia, we decided, you know what? We're very close to where we want to be, but this is not it. So we were able to kind of look around and find that we actually wanted to prioritize living in a countryside home, not on a highway. And we also wanted to be able to reduce our expenses. So the move had to be to a cheaper house. So anyways, we ended up finding that there were not very many homes in our price range. And we were looking for homes that were on land that was specifically able to be used for um, market gardening and raising animals. And so we had very few limited options. What we ended up deciding on was purchasing a newer, so very new, double wide home, manufactured home by Clayton Homes that was already permanently fixed on land. It had already been established. It counts as real estate to the lenders out there. So we were able to get a normal mortgage. All right. So why not get a HELOC now? So that was last year. Why do I not have a HELOC at this point? Well, lots of reasons. One of them being when you buy a manufactured home, banks aren't really as quick to give you a HELOC. Now, this is not something I knew prior to buying the mortgage or buying this home. But what I have learned since is that like the new bank that I'm with, they don't give out HELOCs for manufactured homes. Um, the company that I'm affiliated with, firstlienhelocs.com. I love those guys. They do a great product. It's awesome. It's much better than a mortgage. However, they do not lend to manufactured homes either. So kind of strike two, right? Can't really get a HELOC when you have a manufactured home. Now, I have not done a full digging on this yet. There might be somebody out there, especially if I get a good relationship with a lender, that would allow for it. Um, but at this moment in time, not an option because of that. Also, we lost our relationship with our previous lender, who was a regional credit union in Wisconsin. So moving to Virginia, we didn't really have that option anymore. And then also, we have paid off all of our debt. So at this point, we're debt free except for the mortgage. So it kind of reduced the need to pay off debt with Velocity Banking. And so now we're kind of in investment mode and pay down the mortgage mode. So at this point, I don't really need it for that. Um, I am looking at potentially at some point getting access to a HELOC when the house is paid off, because when you pay off your house, you have a lot of equity there that you can't tap into unless you sell it. And granted, that also means you don't have a mortgage payment. But if you needed it, it'd be nice to have access to it. When you get a HELOC, you don't actually need to pull any money out. Just having it open can be good. Anyways, the other piece of this is our infinite banking concept policy, my life insurance policy I talked about in another video. It provides us with a savings cushion. So I don't really need a HELOC to tap into funds that are available to me if I have a big project or an unexpected expense. I actually have put away a bunch of money into that account, that policy, which gives me the cushion that I need. Here's another idea, something to think about. Income. Income's a very important thing. Something that I didn't really think about too much when I was just a W-2 employee with two incomes in the home, with a well-established career and things like that. Moving across the country really shifts things when it comes to income. You really need to have your income figured out. And most lenders actually don't want you to move across the country to a job you've not worked at before because they don't know that you're going to actually be making that income yet. So it can make it really tricky. Fortunately for me, I have in-laws who were able to co-sign the loan for us, and my new job was a W-2 job that did have a guaranteed base income or base salary. So we made it work, but it really was not ideal. Um, the other thing that happened was my personal income shifted from business owner to W-2 employee. My W-2 income dropped from what I had in the past. Didn't really have a lot of cash flow because our expenses were higher. Also, after a while, I shifted to being an independent contractor as a therapist, which was great for the income, but it actually doesn't count towards mortgage income. So went to maybe get a very low money down loan while we still owned the house to try to put a manufactured home, a brand new one on a piece of land. That wasn't an option for us because my income didn't really count towards getting a new mortgage. So we had to kind of finagle our way into the mortgage that we're in right now on this second home we bought in Virginia, basically because I had already shown a year's worth of income as a W-2 earner. That helped a lot. Um, but I will say, if you're an independent contractor looking to get a loan, kind of important to have established income. Um, what I found is that an independent contractor actually needs to have 2 full years of income that's visible on the tax returns in order for it to count towards mortgages. So I was still within year one, made it a lot harder. Also, to make matters more complicated, but actually much better for us, is we decided that my wife should stay home from working as a nurse. So we went from 2 incomes to one. This allowed her to be fully present with the kids and for me to be the sole earner. It meant lower income, which is another reason why we needed to reset and we needed to reduce our expenses. We needed to be able to get to this place where our cash flow was good again. And I'm happy to report that by September of last year, our cash flow got back to a really healthy level. In fact, the healthiest level it's been in a long time. And that's because of the fact that we chose to live in a home that was very affordable for us. We had taken earnings from previous home sales. We put it towards this house. We put like a 50% down payment down to get into this house. So our mortgage payment's low and we're crushing it every month. We're trying to pay a ton of extra money towards this mortgage. Now, I would have personally preferred to buy this house and finance this house with a first lien HELOC. And I would have used firstlienheloc.com. Those are my pals, my buddies. But I'll tell you that as of right now, they don't send out any HELOCs to manufactured homeowners. So that is a disqualifier for me, even though I'm pals with them. I just didn't buy the right house for this particular application. Maybe someday, right? And I'd be happy to share my results with you in the future if that does happen. I still cannot qualify for a HELOC because I haven't shown 2 full years of independent contractor income. So I'm just kind of waiting right now. All right. Here's what you need to know about qualifying for a HELOC. So if you're in a position you're like, you know what? I still like this velocity banking thing. I'm not going to be moving very soon. I really need to pay off these debts. I want to be able to invest in a real estate option. Then a HELOC could actually be great for you. But what I'll tell you is don't go through all this process if you know you're going to move pretty soon. It's not worth it. It all goes away and you got to reset. If you're going to make a shift from W-2 to independent contractor, don't do this. It's going to reset things. It's going to be hard. If you're going to go from 2 incomes to one, don't do this. It's not going to be good. If you're going to put a ton of debt on this and you're not going to have consistent cash flow, don't do this. It's not going to be good. So there's a lot of reasons not to do this. But if you decide, hey, I have some really good reasons to put this in place, then what it comes down to is here are what you need to know. You need to have good income. Your income needs to be before taxes 45% or better. So sorry, your DTI, debt to income, needs to be 45% or less. So what you do is you calculate gross income per month and gross monthly payments on your debts, car loans, student loans, mortgages, things like that. When all of those are calculated, you have to have your loan payments be less than 45% or less to your gross income per month. And that would be after they put the full HELOC limit out there with whatever that monthly payment would be. So you got to figure out what your DTI is after, like if you were to imagine a scenario that you're taking out all of that HELOC limit right away and what that monthly payment would be, that's how the bank looks at it. They say this is a loan. So if it's a $100,000 HELOC, they're going to run your debt to income information based on you having maxed out that $100,000 HELOC, because that's what people oftentimes do when they don't know how to use a HELOC. subcategory here, if you're self-employed or a business owner, you need to have 2 years of tax returns in order for this to work. Another thing you need is good equity. So you got to look at your loan to value of 87 or 80%. There are some that'll go up to 90%, but what you got to see is total value of the home. This is an estimate. Subtract out, or so take the total value times 80%. That's your 80% LTV. Then you take that number and subtract out the mortgage value that you have left. That's how much equity that you can access. That is a number that if it's only like $15,000 or $10,000, it might not be enough to really jump into velocity banking, in which case I would say, hey, just work on paying down that mortgage, right? Or if you got a lot of debt, maybe you'll take what you can get to use as a debt tool to pay off your debt. That could still work. And that would take some strategizing with a coach like me. Good credit, that's your third thing you need. So a score of 650 or higher is typical, but most places actually want you to get 680 or above. That'll give you the best rate. So here are your types of HELOCs. You can get a first lien HELOC. I would definitely refer you to firstlienheloc.com. They're my buddies. They offer a product that is hands down the best out there. So if you're wanting to get rid of your mortgage altogether, have access to the fastest way to pay down your mortgage, that would be the place to go. And if you'd like a second lien, so you say, hey, I got a 2.5% mortgage that I've been sitting on for a long time. I don't want to get rid of that. Most of my balance of my mortgage is sitting on that 2.5%. Great. Just get a secondary mortgage, a second position mortgage that can be an add-on, which gives you the ability to tap into the equity that's between the value of your mortgage and the value of your house, the 80% value of your house. Okay. And usually that's with a different lender than your mortgage holder. Where do you start? Well, here's some ideas. If you want to pay off your mortgage as fast as possible, check out my masterclass video on first lien HELOCs. If you'd like that idea, follow my affiliate link. I am an affiliate. I do get a perk and a bonus if you sign up with that link. So if you'd like to support this channel, that would be a great way to do that. It doesn't change whether you'll get, whether you'll get qualified or not. It's not going to be any harm to you or cost you any more money if you follow my link versus, just going on the website. The only difference is using my link gives me some positive outcomes financially, which helps me continue to send videos like this out. So I appreciate it if you use the link. And then that would be to replace your mortgage with a HELOC. The second option here would be to get that second position HELOC with a local bank. And what I'd say about that is it's really important to look at a local bank. Start with your credit unions in the area, regional credit unions. They're the ones that are going to be most likely to lend to you for second position HELOCs with favorable terms. I have a lot more information about how to pick out a good HELOC for velocity banking, kind of behind a paywall. If you are interested, I have a mini course about that as well. Feel free to send me an email if you have any questions. Be happy to help. And until next time, thanks so much for watching.